Hey everyone, Meet Kevin here. Try this. Type into Google Trends, quote, stock market bubble. And since there's a good chance you are just going to listen or potentially watch and not actually do it, I will just go ahead and show you what you would expect to find, or what you will find. Here you go. Stock market bubble over the last 5 years shows that we are at the peak for stock market bubble searches, with the highest percentage of searches coming from Connecticut and California, and related queries being stock market bubble 2017, stock market bubble 2020, and wait for it, CNN money. Folks, is it possible that the insane stock market run that we have seen will utterly collapse under a Biden administration? Right now, we have the belief that Democrats have control. They should easily be able to pass policies related to infrastructure, climate change, minimum wage, stimulus checks, more unemployment, more forbearance, more rent forgiveness, no foreclosure crisis, no real estate crash, electric vehicle special tax credits and solar tax credits and cannabis and immigration. All of these are hopes, but is it possible that all of these priorities of the potential moderate Democrats, at least the moderates that there are, not necessarily the far left Democrats, but is it possible that moderate Democrats will push all these things through and the market will get rewarded for investing in EV and energy and infrastructure related companies and even cannabis? Or is it possible that Democrats could entirely flounder the opportunity to use their 51-vote budget reconciliation tools for basically Biden's opportunity to say, you know what, we're going to do whatever we can to unify the country, which is what he said during the inauguration today, unify red versus blue. Does that mean power sharing between Chuck Schumer and Mitch McConnell could lead to gridlock and all of the excitement we have over all of these priorities getting passed and done will end up falling flat and not actually happening? That could be very bad. On one hand, that would be bad, certainly for the cannabis industry. It would probably be bad for the solar industry. It would probably be bad for the infrastructure industry if we did not see these benefits come through. EV seems to be on a self-sustained rocket ship to the moon. At least that's what the memes on Wall Street Bet say. But, hey, maybe there would be some good. Maybe it would mean that corporate tax hikes would get delayed, because we are expecting corporate tax hikes. I mean, even Janet Yellen implied that they're coming, maybe not soon, but they are coming. She says that we can still have companies be competitive in the global economic sphere, so to speak, with higher tax rates. We don't have to be a part of the race to the bottom in the lowest tax rates, which is a priority that Donald Trump had. Let's lower corporate tax rates. He did. He even suggested at one point lowering corporate tax rates even further, down to 15%, which didn't happen, of course. But then again, he suggested that as his campaigning, or as he was campaigning for his second term. And obviously right now we have a President Biden. So this is where we have to scratch our head and say, how much can Biden really get done? Democrats did just take control, and after Democrats took control, it seemed like you almost immediately had AOC potentially representing a little bit more of the far left, suggesting, hey, you know what? Biden, bro, $1,400 is not $2,000. You said $2,000. $2,000 is $2,000. Where's the $2,000? Basically, you already got AOC on the left calling Joe Biden a liar for offering $1,400 stimulus checks instead of $2,000 stimulus checks. Joe Manchin, who's deemed to be more in the middle in terms of being a Democrat, is complaining that $1,400 stimulus checks aren't targeted enough. Janet Yellen yesterday says, no, don't worry, the stimulus checks are targeted enough. So on one hand, we've got a market that is banking on stimulus happening. The market is basically pricing in, we are getting a stimulus package by the end of February, by the middle of March, somewhere around there. Bloomberg has already concluded that the package will be at least $900 billion to $1 trillion, and that it will get done, and that energy sectors, China trade sectors, medical marijuana sectors, because of this, are booming. Heck, even Alibaba is soaring back, although that could be because Jack Ma finally showed up again. But anyway, reality here is we might see a whole lot more drama that we weren't expecting in these stocks. I mean, think about the potential of Biden ending the Keystone Pipeline partnership between Alberta, or that runs between Alberta, Canada, and Nebraska, down to the Gulf Coast, where we can refine up to 830,000 barrels, or at least deliver 830,000 barrels of oil a day. per day. Now, some people like Jim Cramer, he tends to lean a little bit more left, suggests, Keystone Schmipeline, who cares? We don't need it. But other people see the Keystone Pipeline as a crucial piece of infrastructure that Biden already has announced that he will be ending. Now, this is a project that got crushed under Obama. Trump made it happen, and now Biden plans to undo that, just like stopping the building of the border wall. And the implications for this remain to be seen. Then we have China. We thought that Trump was tough on China, and we think that Biden will be more accommodative. But in the last few weeks, and maybe it's just political posturing, but in the last few weeks, Biden has really been stepping up for a tough talk on China campaign, or potentially even tough action on China campaign. It doesn't help that Yellen regularly and openly discussed addressing unfair trade with China and punishing China, potentially even sanctioning China for shady trade practices, we could say, which means we could see political turbulence coming from breakdown of the Keystone Pipeline negotiation and project with Canada. We could see turbulence with China very quickly. Now, I'm personally less worried about a real estate correction, but if we start seeing that kind of political turbulence, while at the same time we have political turbulence in the Democratic Party because they can't get their act together, maybe all of the hopes and promises we have end up combusting into a big flat set of nothing, which would be a little bit of a bummer, and that would imply that it's entirely possible we could see a market correction in the first few weeks of a Biden administration, maybe even the first 2 to 3 months of a Biden administration. Now, this is something to prepare for. We also do know that inflation will be higher year over year in March and April. But what's to come after this? Well, we'll see. According to Janet Yellen, we're not expecting to see inflation soar back dramatically for the next, potentially even the rest of this decade. And Janet Yellen does not see interest rates moving much higher anytime soon. She doesn't think we're going to have much of an inflation problem, which could be very true if the velocity of money stays low. Right now, the velocity of money has plummeted because people are taking more of their money and they're throwing it into stocks and real estate and savings or paying off debt. That reduces the amount of money that circulates through the economy and actually helps keep inflation low. That's not going to be good news to the Bitcoin crash. So it almost seems like we have a lot of bets on the table right now. And at some point, somebody's coming out with a rake and they're going to rake the loser. So let's make that clear. Right now, I feel like we have these contrarian bets. In some sense, we can consider them contrarian because we've got bets on marijuana, we've got bets on solar, we've got bets on EV, we've got bets on infrastructure. We got bets on good things happening with China. These are all chips on the table, so to speak. Maybe we're going black over here, and then we're going evens over here, and then we're gonna go top third over here. Are we gonna get all of those? Now, those not necessarily being contrarian, but then take the flip side approach. These stocks probably wouldn't be doing super well if all markets or all market participants are like, yep, definitely we're going to have a massive inflation crisis and interest rates are going to skyrocket very soon. In that case, you would see more of a Bitcoin pump, which Bitcoin is struggling a little bit. It's having a lot of resistance at that 40K level. It's bouncing up around that 35 to 37,000 level pretty aggressively. And some people are wondering, if Bitcoin can't break out through 40, does it mean we're going to see a more substantial pullback? Is it possible that more substantial pullback ends up coming after the inflation readings in March and April where people are like, that's it, inflation is high, we knew inflation would be high, and then all of a sudden May rolls around, the May data rolls around, which comes out a month later, so in June. So in June, we're like, oh wait, inflation's going back down. There really was no inflation. That would not be good for Bitcoin. People could be sorely disappointed in investing in Bitcoin if inflation doesn't show up. People could also be sorely disappointed if we don't end up getting any kind of cannabis policies, or we just don't see the stimulus packages as soon as we think, or it's harder to get stimulus done, which implies it's going to be harder to get the infrastructure package done, which implies it's going to be harder to see those energy credits. There is a lot of hope and potentially froth in the market right now. And when we see this kind of hopium, it's very possible that we are going to see a short-term correction. And now, I personally do not believe that we're going to see any kind of long-term market crash. We're not going to see something like a 2008. We're not even going to see something like a March of 2020 when the pandemic hit. So in the short term, I think the word of caution is we should probably keep an eye on our debts and our margin exposure, which I continuously say I'm trying to be on the stock market diet, but like most diets, I'm failing pretty miserably. I keep buying stocks. My stock market diet is supposed to be Kevin, stop buying stocks for a little bit to pay us some margin. I have to say, maybe I feel justified because I only have about 21% margin outstanding. But take a look at this. This right here also shows us that, according to Bloomberg this morning, there's no sign of a margin bubble either. In fact, margin is at substantially lower levels right now than it was leading up to the 2008 recession, which is when margin levels were right here at very, very high levels. And margin levels are actually substantially lower right now than where they had been before the pandemic. So in an odd way, even though interest rates are going down and it's cheaper to borrow, margin debt as a percentage of the S&P 500's market cap is very, very low. Now, I suppose that does mean that margin could nominally be going up, but then again, people's actual wealth is going up substantially too. I mean, I've never had $4.5 million worth of margin before, until now. So relative to the last few years, I have way more margin than I ever had before, but I also have way more equity in these stocks. I mean, we've got a $20 million stock market portfolio we talk about here, and that's not even to mention the real estate portfolio, which easily doubles the entire portfolio. So this is where, there are a few things. Well, we can also look to China. I do want to mention that really quick. We can look to China, and we can see what's happening in China. And folks, you go look at China. China's killing it. China's economy is booming back faster than we expected. China's margin debt is also similarly low to what we're seeing in the United States. You'd think we'd be seeing a substantially more ballooning of margin, but we're not really seeing that. We've seen some increases in Chinese margin, but nothing substantial or mega scary. It's very similar to what's happening here, and a lot of people look to China or even Australia to say, hey, what's ahead and what's ahead of us. But anywho here, the thing to ask right now is, what should we expect over the next 2 to 3 months? Is the market going to crash? And how do we put all of these pieces of the puzzle together, so to speak, and come up with a conclusion in terms of what we should do? And here are my thoughts. So rule number 1 is always BTD. And that is buy the dip. So rule number 1, buy the dip. Some people just refer to this as BTFD. They add the F, so buy the dip. That also works for rule number 1. So I do think if we end up having a sort of like realization sell-off, like, damn it, politics is still politics. Politics is still slow and immovable and not as efficient as we think it is. Here we are thinking like, oh, everything's going to be a cakewalk now because Democrats have all the power. So of course all these things are going to do well. Maybe not. Maybe not. Who knows? I mean, there is good news on the horizon so far already that China's already opening up the door to potentially more, fair, or maybe not, I shouldn't say fair, but more open negotiations and discussions with Biden. China today sanctioned 28 members of the Trump administration, and that is coming on Inauguration Day, is a very clear sort of line in the sand saying out with the old and in with the new. We're now interested in the Biden administration. We've sanctioned the old. That's a pretty big political statement here. And maybe China's saying, hey, look, we want to work with you, Biden. And so that's why I think BTD, buy the dip, is going to be so important here, because sure, we have a lot of hopium right now, and we might see a lot of that hopium get deflated out of that bubble, the bubble that's so blown up right now. I'm like, but there's so much enthusiasm to invest right now, and there's so much money that's been created. Just wouldn't surprise me to see that go, just keep going. And this also doesn't mean that the bubble is at a level now where we're getting so stretchy that like a little prick is going to pop it. It's entirely possible if the velocity of money stays the way it is, we don't see inflation, we don't end up getting rates moving for the next 3 to 4 years. It is entirely possible this could be the beginning, as the Federal Reserve has said, not my words, the Fed has said this, this could be the beginning of the longest bull market run we have ever seen. That is, forget about the last 10 years. Maybe the next 10 or 12 or 15 years will be even more of a bull market run. And this is why, again, I'm going to reiterate BTD, buy the dip, BTFD. But the second thing to do is, yes, I have a goal of minimizing my margin, which again right now is around 21%. But and I recommend that, and I've regularly recommended keep your debts low. But maybe it makes sense to keep some margin outstanding. Maybe you keep 10 to 15% margin outstanding. Maybe we're not going to see a massive explosion, but we want to couple this with the third recommendation, and that's going to be diversify away from some of the hopium trades. So rule number one, again, BTD, buy the dip. Rule number two, if you have a little margin, that's okay. Usually I'm a little nervous to recommend margin, but maybe if you have a diversified portfolio, 10 to 15% is healthy. I definitely want to get down from 21% closer to that 15%. We'll see how it goes. That's my vision. But the third thing that we might consider doing is diversifying a little bit in our portfolios. And I know this is kind of like a cliche, like, oh yeah, diversify. I've heard all that crap before. But personally, I get a little nervous about having too much exposure in, let's say, cannabis or too much exposure in EV. I'm heavily exposed to EV, extremely exposed to electric vehicles. I mean, I've got half my portfolio in Tesla, which is totally by accident anyway. Sometimes people are like, oh, Kevin, the only reason you're successful is because of Tesla stock. Yeah, look, I get all the cynics. I totally disagree with that because the vast majority of my wealth came from real estate, which I then plowed into the market at the bottom of the market and was able to generate wealth that way. But hey, people will do anything to be cynical, I suppose. But I do have a lot of exposure to EVs. If I add up all my EVs, electric vehicles, I'm probably sitting at like 65 to 70% EV. Probably not 70%, probably closer to 65%, just because I've got positions in NIO, Xpeng, we got some positions in Li Auto, CCIV, I got a chunk of a position in there. We got Tesla, CCIV being the Lucid Motors rumored merger. We've all seen or a lot of us have seen the Bloomberg Terminal tweet about the CCIV and Lucid merger, which, by the way, the citation for that is a Motley Fool article, so don't get too excited over the Bloomberg tweet thing. But anyway, yeah, maybe it makes sense to say, hey, Kevin, you're really big on the EV space. Yeah, that's a Biden trade. Yeah, look, EV should do phenomenally over the next 10 years. But maybe it makes sense to start doubling down on some of my other positions that I have. One of my favorites right now, look, I'm going to quickly just give this an honorable mention. It's Enphase. But Enphase, I really loop into the energy and EVs as well. It's another big position. But maybe I really need to transition over and realize, no, the next big change over this next decade is very likely going to be a company like EXPI, ticker symbol EXPI. It's EXP Real Estate, and that is a massive MLM-style company, not Ponzi scheme style, MLM-style company where we're going to see real estate agents and brokers en masse, almost en viral mass, transitioned from work in office to work at home, and EXPI is going to be the destination for higher commissions for those agents, higher commission splits. As a real estate broker, that's a big play that I see. I think the iBuyer model, especially with the single-family housing boom that we are seeing, which is not only going to benefit companies like Toll Brothers, but it'll also benefit companies like Redfin, Opendoor, and Zillow. I think that is a real trade. And so potentially, I don't want to just do the generic, make sure to diversify. I want to give you some actual tangible insight here. And to me, maybe a good play is now focusing my attention on throwing as much money as I can into the real estate and housing sector. So getting a little bit heavier again, which I'm already pretty heavy, but get a little heavy into the Redfin, the Opendoor up 8% today. So maybe I won't be buying it on green today because that's pretty dang green. EXPI announced a 2-for-1 stock split. Who knows? Is this going to be the move that ends up giving EXPI that hedge fund exposure that people don't realize EXP or the revolutionary change that's coming to EXPI? Maybe people don't even realize that now. People are so caught up on the iBuyer model of Opendoor, Zillow, and Redfin, they don't even realize the disruption that EXPI is going to cause. It's another thing to consider. Is it possible that we should also dump more money on a red day like today for Etsy into companies like Etsy? Get into those consumer cyclicals a little more. Get into the Amazon. Get into the Etsy, the Wayfair, phenomenal company. Staying away from the cannabis and the EV for a chunk of our portfolio. It's so exciting to only be in that EV space. And again, even cannabis and those Biden trades, because we're like, hey, Biden's in, yay, Democrats have control. But we got to be careful. There could be a pullback here. And again, buy the dip, but we don't want insane exposure in one sector. So the more I look at my portfolio, the more I think maybe another way to diversify is by increasing our exposure to 5G plays. And so this is where, if you haven't yet, I would highly encourage you go to metkevin.com/1337v19. You might be able to just type in metkevin.com/1337. Let me see. I think I redirected that. Let's see. No, it doesn't. So you have to type in V19. I'll probably change that though. So either way, you could try either one. But if you click on version 19, at least for the time being, this is what you'll see. And so, okay, whatever, 8% returns from December 20th. This is a very diversified, in my opinion, very diversified portfolio. It's 59 holdings, so it's a lot. It's not like it's a YOLO on GameStop and it's up 100% or something like that. But maybe what I need to do is change this to version 20, and maybe now's the time to take a 34% exposure here to electric vehicles and energies. And maybe now's the time to go to like a 14% housing position here, where we bump housing. Maybe it's time to bump consumer and online retail a little bit, but you know what? Maybe it's time to bump 5G. Maybe it's time to bump my recovery stocks, which I haven't been holding or bumping at all. Maybe now that Biden is in, it's time to pull back the reins a little bit on these particular trades and just be more properly diversified into 5G, fintech, the Squares, the PayPal, sure, housing, probably a big move right here. I mean, Redfin was a 6x stock for me. Redfin was a killer stock. Really great company. We talked about this one a lot in the course. Absolutely phenomenal company. I think I bought a chunk at $10 a share, and bought a lot more regularly in the 20s, the low 20s, so about 4x from about the low 20s. But Redfin year to date, even year to date here, just in January, it's up 17% in January. Year over year, we go back. Even if we go back to October, we're up 43%. Not bad for a company like Redfin. This company, look at the market cap here, $8 billion market cap. We realize that NEO trades for 11 times the market cap of Redfin? And how many people do you think know Redfin more than they know NEO, right? The EV is pricey, and part of it makes you almost a little nervous. Let's do EXPI. Let's look at the market cap of EXPI here. Look at that. Market cap is $6.4 billion. Relatively small compared to these high-flying EV companies. Open Door a little pricey at 16.4. I think Open Door is a little pricey here. But even looking at CCIV, and look, I've plowed money into this stock. I think there's huge potential here. But keep in mind that Lucid, if this merger happens, CCIV is only going to get a share of Lucid's market cap. So, at $18, this could be more like a $25 billion market cap for an automotive manufacturer that has not produced a single vehicle yet, or at least sold a single vehicle yet. They are producing test vehicles and such. So I do think there is serious reason to do a little bit of rebalancing. And I think the easiest way to recommend doing that is, if you feel unbalanced, is consider using an app like M1 Finance. And I'm not just saying that because, y'all know I love M1 Finance and that. And y'all know you could use the coupon code down below to get 38% off on the course. Y'all know you can get $30 with M1 Finance when you deposit $100. And you know that you can get 4 free stocks with Webull when you deposit $100. But M1 Finance might be a great opportunity to create a pie to where you could actually see what your diversification balance is. Are you out of balance? Are you out of whack? Are you prepared for a potential fall in the hopium trades that are, Biden trades? Let me know what you think. I'd love to hear it. I'll check the comments down below. I really appreciate y'all being here. And folks, we'll see you in the next video.